Hello everyone, it's Hiền Nguyen from ST Consulting. So today I'm back with a new topic. People are talking about the situation of the interest rate at the moment and inflation relation at the moment is somewhat worse than the Great Recession in 1929 and also 2008. So let's look into this together, okay? In May 1929, interest rate in the US hit 5% for the first time in 8 years. This was followed by a most severe economic downturn in history, where unemployment surged to 26% and interest rates fell down to 0%. Now, as in May 2023, interest rates in the US also hit 5%, but this time for the first time in 16 years. The last time rates in the US at current levels was in 2007, before the global financial crisis. Now, where interest rates haven't risen over the past for exactly the same reasons that we saw in 29. Today, they were mostly been raising interest rates to fight the elevated inflation rates that we've had over the last couple of years. In 1929, the Federal Reserve was raising interest rates in order to fight stock market speculation. The stock market was in an absolute frenzy in the 1920s, and the Fed decided to raise interest rates from 3% to 5% in order to stop the stock market speculation, which was of course followed by the largest stock market crash in history. But the question today is whether the economy can actually withstand these higher interest rates that are now higher than levels seen before the global financial crisis and higher than the right before the Great Depression you can see in both 2008 and early 1930s. We actually saw inflation go negative into deflation because of how deep the economic crisis was. The Federal Reserve believes inflation today is just going to gently become back down to 2% and stay there after the big rate hikes that we've seen. But as you can see from this chart, their track record is putting off this type of stunt isn't exactly perfect. We've seen wide spikes in inflation, both in the upside and to the downside throughout history. So it's a big deflationary spiral like we saw in the 1930s. Can we expect something to that extent to happen over the next few years? That is the question I'm going to discuss and for you today. In order to do so, we need to actually look into the real chart of consumption price index. This is just the inflation rate, so it's change in the consumer price that you can see that we get every single year. This is what the consumer price index actually looks like since the starting time when they started to measure this index in 1913. You can see that it basically almost always goes up over time. This is an index that basically checks the price for everything and how you are evolving over time. The price of the petrol at the pump and the price of food at the supermarket, everything. is counted in here and basically averaged together into the big number called consumer price index. And they were being measured, as I said, since 1913. It turned out that in human history is the first time the people could actually keep up with that crisis, doing how it's doing national scale now with around it's almost 110 years since the start of time. Just basically go up over time, all the time, especially after the World War II, where the consumer price index has basically just been rising non-stop. And we now understand that as the economy expands, as GDP expands, that's a good way to basically check the economy while the amount of money in the circulation expands, which tends to lead the prices higher indefinitely. But we didn't always know that was the case if we look at this period between 1913 and the Second World War. We saw a period of time where the consumer prices was actually declining severely for extended periods of time. This is a big deflation that we saw in the early 1990s, where consumer prices declined severely. So why was that happening at the time, and why haven't we seen anything like this since 1933? One big theory behind this is human psychology. Let me explain what I mean. You can see on this here after World War II, which ended in 1918, we saw a massive explosion in the prices, a huge inflation post-World War I. Now after that, inflation was done and things started to cool down a little bit, right? Many people thought that prices would have to come back down to the levels where they actually began getting tracked in 1913. The idea the prices could rise forever wasn't very popular at that time. Almost sound ridiculous, When you think prices are going down in the future, what if everyone tell you that, okay, next year the new model of phone is going out and it's half price of this year? What will you do with the current model of phone? Okay, you will not buy it. You just hold it and wait until next year, right? Next year to buy the new phone model, which is cheaper one, right? So that is the human psychology aspect during that after the World War II. When you think prices are going to decline in the future, you don't spend, and that is when people stop buying and stop spending, and the business needs to lower their price to try to attract customers, right, at that time. And that also lead to profit margin decrease. And then because of that, they need to reduce the costs, and that's they have to lay off people, and that's the unemployment rate went up so bad. So the new cycle started again. That's how it gets deflationary spiral, where consumer prices can decline severely. And luckily for us, at this moment, that is the key difference between today and the Great Depression time. Because today, actually, we even think the opposite way. We understand that the prices can rise over time without necessarily needing to come back down the levels that started before. So we know that most economists believe is the key reason behind the two most severe depression that we will have over the last 100 years into 1921 depression and the Great Depression as well. So it's kind of opposite problem with what we are having today. Because if I tell you that, okay, next 4-year phone model is going to be double this year. So if you think that the price is constantly going up, so you don't wait for next year to buy the phone, you just buy the current model. So it's a reasonable price and it's necessary when you want it's cheaper, right? That's what we have today. So that creates a huge amount of demand for the phone today, lead to the next year model of phone increase in the price as well. So this psychological expectation of prices and of people, and that is the difference between our today and the 1920s. Okay, that's not only the thing that drives the economy right into the population growth decline to nearly 0%. That you can see in the chart here what the population growth looked like in early 1930s during the Great Depression. An extremely low population growth must be bad for the economy, right? Because we also have increasing concerns around job automation. This is the number of looks that talk about the job automation within them, and this is only data up until 2019, right? So this doesn't even include the huge surge of popularity that we have with chat GPT and with the AI that is leading to historical amount of concerns around job automations. Concerns around job automation, should we not be seeing something like this extend even in 2020 when the entire world was locked up, not able to spend unemployment with skyrocketing to the highest percentage since the Great Depression. Even then, we only saw a very small decline in the consumer prices, nothing like counterbalance that could be a huge deflationary spiral after the pandemic. So they turned a deflation problem into inflation problem as we saw in 2020s and 2021. We saw over the last couple of years and until today. This is another key difference between today and the Great Depression. And that is the government and the central bank have the power to counter forces of deflation. That is something they have learned over time, and then you can see in 2008, for example, you had a very, very brief deflation, but you saw economic stimulus and in the form of quantitative easing in order to stabilize the economy that was otherwise heading to depression. During the global financial crisis, so it's unlikely that we will see a huge period of deflation like we saw during 1930s anymore. But we do have some very similar themes that are happening today. But also the government that is actively engaged into spending, which can be very inflationary like we saw in the 1970s. Both deflation like in the 1930s and inflation like in the 1970s caused the volatility of financial markets, right? Both large drawdowns in the market, but also huge, incredible recoveries as well. Both things that we think we will see a lot over the next few years, and is one of the key roles to capture for our clients. So the things that are happening today, similar things that are happening today, but also a government that is actively engaged in spending, which can be very inflationary, like we saw in the 1970s. You know, the government spending with so many deficit budgeting, trouble with problem with hitting the debt, all-time high government debt, right? So in my opinion, there will be huge fluctuation of the market, up and down. There will be huge opportunities for everyone who has the patience to do the investment in the upcoming years in the stock market, the equity market. Okay, be prepared and get ready for that. Take the time to learn the market, to understand the market, understand what has the relation between interest rates, the market, and situation, and prepare yourself, prepare money to when to buy in the long term. It's the markets is going to be performing well, but you also need to see to get yourself prepared for everything. The huge fluctuation up and down. That's what we expect for.
To be a good investor, from my own experience, following are the first important steps you need to do. 1. Prepare yourself by learning investment knowledge through reading investment, financial, and accounting books from famous and successful investors. 2. Apply and practice your learning and find the best strategy that works for you. 3. Before you find the best strategy that you can make successful investment, diversify your investment portfolio and do not put all the eggs in one basket. Remember, no successes come without failures and pains. So training yourself to practice patience is very important. I hope you get some insights and learn something new from this video. Please subscribe my channel for more future videos.